Aditya Shah, founder, Hercules Advisors. Hi, Aditya. Thank you so much for joining us. So what's going on? Is this a rotational play more than anything else that we're seeing, where Street is hunting for momentum and, banks have sat out for a bit?
So good morning. So as I have already been saying that larger banks like ICICI Bank or an HDFC Bank continue to do extremely well. We've seen HDFC Bank, HDB Financial's IPO coming in, so that is why the stock moving up. The larger private sector banks continue to do extremely well. The smaller private sector banks have an NPA problem in the microfinance space, and since they have a problem, larger private sector banks have taken over. They will continue to do well until the smaller private sector banks come in. So you need to make a mix of larger private sector banks as well as smaller private sector banks. PSU Bank should be completely out. I believe that the valuations are fully priced in now, and I don't think there's any upside left there. So mixture of larger private sector banks and smaller private sector banks together with an avoid on the PSU banks.
Aditya, hi. Just a couple of questions from my end on the earnings front in terms of what you're anticipating in FY26. Couple of questions. One, what is the mix of what is your estimation of loan growth, particularly for the large banks, and what is the mix that you anticipate? Do you at all see corporate lending coming back into the fold? One. Two, there's expected to be a net interest margin compression on account of the fall in the policy rates, but at the same time, you're going to have that CRR push that comes through towards the end of the year, calendar year, that'll bolster things somewhat. So how much compression do you anticipate heading into the last quarter of the year?
See, Alex, the net interest margin compression will be very temporary in nature. As deposit rates also settle down, you will find that NIMs come back. I expect 10 to 15% of loan growth coming in for all larger banks, particularly HDFC Bank, which has seen practically zero loan growth because of whatever merger problems that they had got. But if a bank operates normally like an ICICI Bank, 10 to 15% growth is very good. The NPAs are in control for all of these banks. So not a problem per se. I believe that now as HDFC Bank continues to recover from its NIM problems, where the NIMs have gone down to about 3.4%, you will find that HDFC Bank and ICICI Bank continue to lead the Nifty higher. HDFC Bank is a large part of the Nifty. So I believe as recovery continues to come in, market is starting to price in that recovery with these banks starting to move up. So from my perspective, in the shorter term, these larger banks will continue to lead the market higher. The NIM compression is very temporary in nature. After 1 or 2 quarters, those NIMs will get restored to a normal phase. What you need to concentrate on as larger banks continue to give you stability of returns. Microfinance is the next leg of returns that investors can get if you are able to catch the microfinance cycle properly. Something like a Ujjivan or an Arman or a Equitas for that matter. There's a whole host of returns to be made over the next 2 to 3 years. So very bullish on the sector. The larger banks will continue to lead the market higher.
Aditya, a lot of people talking about how some of the smaller NBFCs, smaller HFCs, which are trading at sub one book in some cases, might just be shoe-ins into the portfolio if you don't quite know how to track valuation or growth, etc. Because the rising tide will at least carry these boats higher as well. Is that a safe strategy, you reckon?
So it's not a safe strategy, it's a risky strategy, but those who love risk can do so. If a housing finance NBFC or an NBFC for that matter is trading at below one time price to book, one needs to identify what the problem really is. If there's asset quality problem, management problem, or particularly any company oriented problem. For example, Spandana Spurti trades at about near about one time price to book, and there's a investigation going on with respect to the book that they've really got. So as I said, for a bigger delta, I would rather play the microfinance NBFC. For example, in Arman Financial, it's a whole host microfinance player, and it trades at about 1.2, 1.3 times price to book. As the microfinance cycle continues to keep recovering, these companies will continue to do exceptionally well. So you have to be very selective, identify the problem, if it is within the management or if it is within the company, and then take on from there. But I agree to that fact. As the tide continues to go up for the sector, even the poor quality NBFCs will start to do really well. So from that perspective, keep an eye on the smaller NBFCs. They may give a higher delta as compared to other companies.
Aditya, any commentary? I don't know if you said it on HDFC Bank. Is it still a buy right now? HDFC, ICICI?
Absolutely, they need to be a part of your portfolio, core portfolio. HDFC Bank is already now starting to price in the recovery in the margins that is going to come in. Of course, the management is working quite hard on recovery in margins. In fact, the management has completely slowed down the loan growth in order to bring down the LDR, in order to make sure that the margins start to recover. The fruits of the merger will now start to kick in only from FY26, and I believe at a 20-year low valuation for the company, it was a blind buy. You could not end up losing money in HDFC Bank. Similarly, for a consistent compounding, ICICI Bank is also doing tremendously well, and that also needs to be part of your portfolio. So, in my opinion, both these two banks need to be the chunk of your financial portfolio. While they give stability of returns, you need to look at elsewhere mispriced assets where short-term problems are there, and then you can make a higher delta there. So, thumbs up to both of these banks. Both of them will continue to do exceptionally.
Absolutely, and they have in the recent past as well. Thanks so much, Aditya, for joining us this morning. Pleasure speaking with you.